Ladies and gentlemen, good evening. My name is Ed Beal. I'm part of the Pan-European Equities team at Aberdeen Asset Managers, and I'm going to talk to you about something rather different from the oil and gas and mining and biotech businesses that you've heard about in the first part of this evening. I'm going to talk to you today about why income actually matters to investors, some of the attractions of investing in the UK, and how Shai's Income PLC, which is the investment trust that I'm here to talk about specifically tonight, goes about generating the level of income that it does. Shai's objectives are to deliver a high level of income, and crucially, together with growth in that income and growth in that capital. If I leave you with one message today, it is that you go away with it, is that we have not just created a portfolio full of high-yielding stodge, the returns from which will be inflated away over time. Our focus is on delivering the yield that we talk about, and growth in the capital and growth in the income. And when we come to the end of the presentation, I hope I'll be able to prove that to you as something that we have achieved. So why do dividends matter? This glass, give or take, well, it's maybe slightly too full. If we can agree that this glass is in around 70%, three-quarters full, that is broadly the same proportion as you should expect your total return if you invest in stock markets to come from dividends and their reinvestment. I think that is quite a compelling image. That quantity of your total return will come from dividends and their reinvestment. We all like to talk about the returns that come from capital, but it is dividends that truly matter when it comes to investing. And Einstein had it right when he said that those who understand compound interest are destined to collect it, and those who don't are doomed to pay it. And that very definitely applies in the context of dividends. But yield is not just for retirees. I think there's a bit of a misconception that yield is just for retirees and people who need some income. And that's not the case. Consider what Einstein said. Yield is actually, it's important for all investors. It is the bedrock of investing in stock markets. And consider dividends. They are the only tangible return that you as an investor receives from your investment. We all love a share price chart that goes bottom left, top right. Looks fantastic. That's great. But those are unrealized gains until we actually sell that investment and take those gains to ourselves. And any day we can come in and we can find that our investment has halved. Dividends, cash is king. I'm a little bit old school from that perspective. I believe that cash is king. I like to have some of those returns in a tangible form in our pocket. And it is dividends and only dividends that give us that tangible and real return from our investments until we realise our investments. And if we consider the role, the little cartoon at the bottom is really just a way of saying, if we consider what the role of a chief executive in any business is, it doesn't matter what his company does or how good or bad his business is. His role is to allocate capital in projects that will deliver returns in excess of his risk-adjusted cost of capital. That's ultimately what his role is. Her role is. He is a capital allocator. And by having that discipline of having to pay his investors some dividends, rather than continually saying, in effect, I promise you in the future, jam tomorrow, by having that discipline of paying his investors some dividends, it puts a constraint and a discipline on him or her at this point in time, and it means that you as that investor do get some tangible real return whilst you're on the journey of the development of the business. And I just finished with the point that dividends are as important to a 20-year-old making their, dipping their toes into the investment water today as they are to an 80-year-old seeking to boost their income by collecting some more yield. That's all very well and good, Ed, and it all sounds great, but does it actually really work? Well, the blue line, you'll have seen these charts before, but the blue line is the total return from the FTSE 100 over the last 17 years or so since we peaked, the famous peak in 1999. And the orange line is the capital return that you've had from the same index. If you'd invested in the FTSE 100 in 1999 at the peak, you would have paid $6,930 for it. And when I left the office just before I came here today, the FTSE 100 was at $7,030, which means that you would, over 17 years, have earned yourselves a return of 1.4%, which I think we probably agree is reasonably paltry, even in current markets. Had you taken those dividends and reinvested them in the markets, you would have had a return materially in excess of 100% more than you'd have got if you'd invested the capital simply in the capital markets. And this gap between, this gap between the blue and the orange line will only ever get wider, because with each passing year, there is another year of dividends that have been in the market, reinvested in the market, re-earning those returns. Going back to Einstein's point, that is the power of compounding happening in front of you. We can see that the two lines broadly track each other at the start, and gradually this gap widens and widens and widens and widens as we benefit from taking our dividends and reinvesting our dividends. Fairly simple, I'm sure everybody's familiar with it. It is a truth of investment, but I think it bears retelling to people. Quite a lot on this slide, and when I have longer on the podium, we can talk about some of the things that are on this slide. But really, just in terms of how do we think about dividends when we're thinking about the businesses that we're going to invest in? We think about dividends as being the output of a business model. And again, this might sound fairly simplistic, but if I have a well-managed business with a sustainable business model, then almost by definition, that is a company that should be able to pay me a dividend. And I think it is quite an interesting touchstone to ask of a business, well, if the business can't pay me a dividend, why is that? And is this business really the business that I think it is? And is it really the high quality and crucially sustainable business that I believe I'm investing in? Because at the end of the day, if I have cash flows to pay my investors a dividend with, then I have cash flows to reinvest in the business and sustain that business. If I don't have those cash flows, how do I sustain that business over the medium term? I'm fully aware of the fact that businesses have a life cycle. With a different hat on, I manage a small company investment trust. So I do accept that and understand that businesses have different stages in their life cycles. But I would ask you just to consider this as a question. Why would you invest in a business that can't pay you a dividend? And I would go as far as to suggest to you that really you probably, you should think long and hard about investing in a business that can't pay you a dividend. Dividends they can't be financially engineered. We can do all sorts of things with profit and loss statements and balance sheets. Accountants can profit and loss statements and balance sheets and even cash flow statements can be manipulated to the benefit of the management and at the detriment of the investor. But at the end of the day, if there aren't pounds in the bank to pay that dividend with, then you, the investor, will see that very rapidly. They have to have the cash to be able to pay you the dividend with. Dividends don't negatively impact management behaviour. It goes back to that point about conservatism that I was making before. There are other forms of shareholder return that perhaps can incentivise management teams to behave in ways that are not necessarily to the advantage of the investor. They might choose to engage in share buybacks to boost their earnings per share because their stock option plan is based on earnings per share growth. I give that as an example. There is no negative reason why a management team would choose to pay a dividend. They positively affect management behaviour. And again, a bit of a rule of thumb, but I think actually the way that a management team thinks about and talks about its dividends is a pretty reasonable proxy for the way a management team thinks about and talks about its investors. You'll have seen this as well. The orange line is the gilt yield, and the blue line is the dividend yield over a reasonable time period. Had you invested just before the great financial crisis, just immediately prior to that, you would have needed £2,000 in your portfolio of gilts to deliver you an annual income of £10,000. If you conducted the same exercise yesterday, you needed £1.9 million to achieve the same result. I think I can stand here comfortably and say to you that the yield available from equities is an attractive proposition. That's all well and good, Ed, but why the UK? There's lots of exciting things happening in emerging markets. Crikey, you work for Aberdeen Asset Managers. You're known as an emerging market house. Why do I want to invest in the UK? Well, the first thing I'm going to say to you is another investment truism, but again, it happens to be a fact. Stock market returns and economic growth are not correlated. Intuitively, people look at economic growth and think, well, this region of the world is going strongly. Stock market returns are likely to be positive and favourable. And whilst that makes sense at the first consideration, because equity markets are forward-looking, they tend to price in those prospects, and in actual fact, the valuations you buy those equities at are generally less attractive than you can buy them in other parts of the world. Do not conflate economic growth with stock market growth. So if we just consider some of the things in some of the businesses in the UK, we have a rich and deep pool of intellectual property. I don't say that lightly. I'm not being flippant, and I'm not just talking about an ephemeral concept that lots of companies have got lots of patents dotted around the world. Take a real-world example, like Rolls-Royce, for instance. There is a business. If I work for an airline and we're going to expand our fleet, and I'm thinking, which engine shall I strap underneath these new planes that I'm going to buy, I might very well have a conversation about whether I buy Rolls or whether I buy GE or Pratt & Whitney or whoever it is. But what I probably don't do is I probably don't go, there's this new emerging market supplier and he'll sell me his engines at a 25% discount to Rolls. We've not got much of a reputation and a relatively limited track record, because if that aeroplane falls out of the sky, I have quite a difficult conversation to have at some point in the future. Or let's take our drug companies, our big cap drug companies, Astra and AstraZeneca and GlaxoSmithKline. We can debate as much as you like what the relative prospects for those businesses are, both against themselves and against their international peers. But there's no doubting that the intellectual property pool that they have is a largely insurmountable barrier. We cannot go out and recreate the IP that these businesses have. Don't underestimate the depth of intellectual property that resides within the UK. And even if you haven't completely emotionally bought into my comment about the fact that stock market returns and economic returns are not correlated, 70% of the revenues earned in the UK by business in the UK come from overseas anyway. The UK stock market is not a proxy for the UK domestic economy, as it is further down the market, perhaps a little bit amongst the smaller and mid-cap companies, but not amongst the large-cap companies. And why is that? Well, fairly simplistically, we're an island. Several hundred years ago, we had to start trading overseas. We'd exhausted the possibility of trading with ourselves. We had to start trading overseas. We have a level of expertise in this country that is significantly greater than many other countries yet have in terms of internationalising their businesses. So we sit in a globalising world. We are well positioned to benefit from that globalisation. Despite what the media would have you believe, we do actually have a pretty deep pool of skilled human capital in this country. Sure, there has been a transition from manufacturing to services, but nonetheless we have some very skilled people. We could always do with more. That's self-evident, goes without saying. But we do actually, relative to other regions, that is a position of strength that we are coming at markets from. And then this point, which seems terribly dry, and I put it at the bottom, and really arguably I should have put it at the top, because this point is absolutely crucial. If I buy a share in the UK, I get a vote. And if you buy a share in the UK, you get 10 votes. And if you're the majority owner with 60% of the company, you get 60% of the votes. But what you can't do is you can't engage in activity that creates the unfair transfer of value from me, the minority shareholder, to you. You simply can't do it. The law prohibits you, stops you from doing it. We don't have to look very far around the rest of the world to see that is not the case. In fact, if we look even as close as the continent, we can see a number of countries where those rules do not apply and where minority shareholders are squeezed by significant and larger shareholders. So the structures that we have in the UK, I'm talking about corporate governance in its broadest sense, and I'm trying to stay away from the box-ticking element of corporate governance. But the structures that we have in the UK in terms of corporate governance provide you as an investor with a significant level of protection that just isn't available elsewhere in the world. Now, how you price that into markets is for you to form a view about. But nonetheless, I would argue that it is our corporate governance structure in the UK is a significant strength relative to other areas of the world we could invest in. And that is clearly backed up by the legal frameworks that we have in the UK. Okay, Ed, so equity markets in the UK, are they attractive? Well, we could debate the point about valuations for some time. I'm here to talk about yield primarily, so I've put the yields up from around the world with the UK at the top and then the various other major regions as we come down here. And again, I think we can see that the UK yield, I think that is an attractive yield in its own right. I would also suggest that that is a fair bit more than Europex UK, and by the time you get down to here, it is quite significantly more than large areas of the rest of the world. We will move through these next two slides. Just wanted to say a little bit about stewardship, because I think it goes some way towards trying to encapsulate how we think about investing. We do not buy stocks and shares. I will never stand in front of you and talk. I might eulogise about the latest thing that we've invested in, but I won't talk to you about buying stocks and shares, because we invest in companies rather than buying stocks and shares. And we think like the owners of the business, and we try to behave like the owners of the business. I accept clearly we are actually the agents of the owner of the business, but that's semantics. That is how we think and how we behave. And that I think sets us apart from a lot of the rest of the fund management industry in the UK. And it's all, well, I can stand here and I can say that. I'll put a pretty coloured slide up in front of you. But over the course of the last quarter, just in the UK alone, we have engaged with 19 different companies in the UK. Now, that engagement can take a broad spectrum of inputs. It could be about remuneration, quite often it's about remuneration, but it might be about a transaction they're considering engaging in. It might be about some management change that they're considering. It can be about it could be about risk. It could be about their approach to socially responsibly investing from the business's perspective. It can be very broad-ranging. But the point is that it's not just, our conversations with these businesses are not just about these are your financial numbers, this is the analysis we've done, what are we going to do to make some more profit? It's about the holistic, how would you think if you were actually the owner of this company, and what kind of conversation would you be having with the management teams of the businesses that you are owning / invested in? We attend AGMs, not to pick a fight from the floor with the management team, but to build relationships and bridges with the non-executive directors, which is crucial if you are then to influence the behaviour of the companies, because you can only say so much to the executives. But if you have a route into the non-executives as well, it gives you a very different conversation with the businesses. And we vote 100% of the resolutions that come before us. And crucially, we do that as the fund managers. I do that, the guys that are the fund managers on the team. We do not outsource our corporate governance responsibilities either to a third party or to another division within Aberdeen. We do it ourselves, because if you are to be the owner of the business or think like the owner of the business, then you need to be taking the voting decisions as well, because that way you can make the right decision that's right for the company, rather than what the corporate governance code says, this is a box, go ahead and tick it please. What does Shire's income do? I've talked to why income's attractive and how we think about our companies. Well, Shire's invests primarily in UK equities. In fact, its equities are all UK. And then it has a portfolio of high-yielding preference shares, and it has a relatively modest option writing programme as well. And the reason that it does this is because it delivers a yield, as we'll see in the next slide or two's time, it delivers a yield which is significantly ahead of the yield available in the UK market. But we are very cognizant that one of the weaknesses, I've talked about the attractions of the UK market, one of the weaknesses of the UK market is that too much of the dividend comes from too few companies. That 70% of the dividends paid in the UK market come from 15 companies, give or take, in the UK. That's a ludicrously concentrated dividend stream. And so if we are to have a sensibly diversified portfolio, we use these alternative sources of income, the preference shares and to a much lesser degree the option writing programme, to free our hands and allow us to have a more diversified and less constrained equity portfolio. So we have a portfolio that is broadly 3/4, a little bit less than 3/4 equities, a little bit more than a quarter preference shares over here. And then by the time we look at the income, we get proportionately a little bit less of the income from the equities and a little bit more of the income from the preference shares. And so there you can see that diversification coming through. And then to put it into real numbers for you, the top 5 dividend payers in the UK pay 33% of the income, or they did last year anyway. The top 5 dividend payers in Shires paid just a little bit more than 20% of the income. That is a lot. It's still a constant, we're still very cognizant of the fact that 5 payers are paying, broadly speaking, 4% each. But nonetheless, it's a great deal less concentrated than the income stream as a whole in the UK. And that is all the more important when you consider that the yield, as we'll come on to in a moment, is so much more than is available in the UK. So more yield, less concentration, more diversification. And the primary driver for that is these preference shares sitting over here, and there's the contribution here. And this relatively small, I refer to it as a modest option programme. Our view is relatively simple. We spend hours, days, engaging in fundamental analysis as to what we think is the right price to buy and sell these equities at. One of the ways we can engage in that transaction is through the use of options. We use options to execute those trades. One of the advantages of some trades, a relatively small number of trades, one of the advantages of doing that is that brings additional income and revenues into the trust and into the portfolio, which can then be paid out in the form of dividends to investors. Now, right at the beginning, I said the objective is one of high income, but with growth in that income and growth in that capital. To try and support that, these are some of the businesses that we have, I keep pressing the wrong button, forgive me. These are some of the businesses that we have introduced relatively recently, over the past 2 years or so. These are the yields that they were yielding at the time that we bought them. When I said to you that we have not just filled this portfolio full of high-yielding stodge, the returns from which will eventually be inflated away, I think this actually provides some credence to my comments. I mean, 1 or 2 exceptions aside, we've been buying businesses that actually yield less than the market. And then I said to you, but growth in that income was fundamentally important to us. Well, these are the 3-year growth track records of the dividends paid by these businesses. So, I mean, at a minimum, we want inflation and a bit. In actual fact, we can see that we've had significantly more than inflation and a bit in most instances. And then I also said, yes, but we also want growth in the capital from the portfolio as well. Well, at the end of the day, going back to what I said earlier on, if you don't make real profits that turn into real cash, you can't pay a dividend. If you want to deliver this kind of growth in your dividends, you have to have delivered reasonably impressive growth in your profitability as well. And so there's the capital side of the triangle as well. So relatively lower yields that allow capacity for growth in those yields, a demonstrable track record of that growth coming through in those yields, and the associated growth and profitability that has supported the payment of those yields. Oh, and down here, by turnover, just to be clear, I'm talking about the buying and selling of shares in the portfolio, not the sales generated by the companies in the portfolio. So 6%, I mean, it happens to be particularly low at the minute, but it's normally below 10%, suggests an average holding period of in excess of 10 years, which again lends some credence to the notion of us being long-term investors, owners of businesses, not buyers of stocks and shares. So the acid test is, does it work? So these are our 1, 3 and 5 year performance numbers, and you can see here that we are ahead of the benchmark over 1 year, we're ahead of the benchmark over 3 years, and quite nicely ahead of the benchmark over 5 years. So I think we can tick the box that we have delivered outperformance. Are those returns attractive? Well, I think 92% total return over 5 years, in round numbers that equates to a 14% compound annual rate of growth. I think most of us, I would accept that as an investor, I think most investors would accept that as a reasonably attractive proposition. So I think the attractive long-term returns and outperformance are there, with a 5.3% yield. So the market's yielding whatever it's yielding at the minute, up and down, but let's say it's yielding a little bit less than 4%. That's somewhere between 25 and 30% more than the market is yielding, which is a lot. I think that's quite a lot more than the market. And then I would remind you what I said about, yes, but with more diversification and less of the concentration that you experience in the market as a whole. If we look at the majority of income-orientated trusts and vehicles in the UK, you see a lot of commonality of companies. You see that concentration of income. You see rather less commonality of companies, rather less concentration of income in this portfolio. We've got getting over 15% in small companies, for instance. And I make this point here about us having a long history. Now, forgive me if everybody in the room is familiar with how the mechanics of investment trust, then you'll know immediately what that means. But for those of you that aren't, as you earn your dividends in any given year, you can tuck some away in a particularly good year, and you can pay some out when you have a rainy day. The longer your history, just by dint, by dint of having a longer history, by definition, you've had more years to collect a bit and put a little bit away in the good years. And in markets, you will, by definition, have had fewer poor years, because that's the way that markets work. And therefore, as a function of that long history, we have 1.2 years worth of dividend in reserves. You may not all be investment trust aficionados like me, but let me tell you, that is a particularly strong position in the investment trust sector. 1.2 years is a very strong position from a level of reserves. And why is that important? That is important because it does three things. It gives us, as the manager, the confidence and the ability to say, let's make the right investment decision for the trust, not we've got to go and get some income to support that dividend. Where are we going to go and get that income from? That's not the conversation. The conversation is, what's the best total return available? How are we going to get that? Go back to those companies I was showing you that we've invested in recently. The knock-on effect of that is it gives the board the capacity to be able to say, it's been a good year, took a bit away. It's been a rainy day, take a little bit out. That gives the board the flexibility to talk about dividend sustainability and, over the long term, dividend progression, going back to that original objective. And they can do that because they have this firepower sitting behind them. And the third thing it does, I hope, is that it gives our investors, and the feedback we get is that it gives our investors the confidence to believe that when the board talk about sustainability and progression, they are coming from a position of strength, and therefore they are likely to be able to fulfil on expectations. And so I will leave you with 3 points, which basically are the 3 opening points. Dividends are absolutely the bedrock of investment. They are a key component of total returns. I do believe that the UK market has some really attractive opportunities, despite people that might tell you that it's all about emerging markets. And I do believe that the Shire's income portfolio is a well-diversified portfolio from a capital and income perspective, but that we do deliver a materially above average level of yield. Thank you.
Anyone got any questions at all? Gentleman right at the back.
I wouldn't ask you this question if it was before February's budget this year, but whilst everybody probably classically agrees with what you've just said, and most people in here are probably private investors like me, this budget is going to create a major problem for people that invest for dividend with the new 5K level of free tax, and then anything between 25 and 40% for everybody, and they need to do returns, etc. Has your company come up with a magic solution how to obviate that?
No. I mean, no. I mean, both the Investment Trust Board, which is separate from Aberdeen, have both considered the problem, and neither of them have anything that addresses that at all. No.
It does, in a way, it actually takes away your trust, doesn't it? It is a problem for everybody.
Well, it is certainly an issue, but let's not forget that dividend income is paid by the companies, is paid gross, and bank interest, most corporate bond interest is paid net. It's paid out of franked income rather than paid out of unfranked income. So you are actually, you do have, there is an element of a tax advantage from a dividend income perspective. But I take your point that depending on the level of income, because it's not an issue for everybody, is it? But for some people, very definitely, there comes a point at which they will be worse off collecting dividend income than they were prior to that point. But that barrier is set at it's wherever it's set, 25 or 30,000 pounds. So it's an issue for a lot of people, but it's not an issue for everybody. And it doesn't detract, I don't think, from the fact that if you're going to invest in stock markets, I've been drinking my juice. A bit more than that is going to come from those dividends and that total return. And that if you do want some yield and some income, I'll look all the way back through the slides. What is the alternative? The bank's not an alternative. The fixed interest market is not an alternative. The yield from equities, I think, still does remain quite an attractive proposition.
Question just down here.
Good evening. With your position as managing as an owner of a company, what's your position on stock lending, and does it actually have a material impact on your total return?
Well, we stock lend. As a house, we stock lend. Our research suggests that around 1/3 of all stock that is lent is used for shorting purposes. So 66% of all stock that is lent is used for other purposes, the creation of synthetic dividends, hedging purposes, all manner of things. And that is in and of itself not a bad activity. And that shorting activity is not in and of, there are exceptions, but that shorting activity is not in and of itself a bad activity. It is another method of price discovery. And that if we own something, and we've done our due diligence, and we are correct about this being a quality franchise at an appropriate valuation, and the share price does decline because somebody chooses to short it, well, that creates where was I? I was saying that, and the share price does decline, then that creates an opportunity for us to top it up. So we do stock lend. Those along with the answer. Those vehicles within the stable that stock lend, they get all the fees from doing so that clearly helps them. It's largely material in the case of Shire's income. We don't believe it's one of the great evils. There are occasions when it is. If you've got businesses that are in financial distress, and as we saw when we occasionally have freezes put on shorting, then that is an opportune moment for the authorities to intervene. But in general, we are comfortable taking part in stock lending programs, and we do not, as I say, believe that it's actually really driving share prices down.
Finally, Morris at the very back.
I saw some work recently on what the decline in global fixed income means for defined benefit pension funds, and that they're in a very serious position, and that the average maturity profile is now starting to roll over, given that we've been about 8 years of these very, very low interest rates. Do you have a macro view on that and what it means for your industry and what it's likely to do for demand for dividend stocks and your type of funds?
Ooh, that's quite a broad. We could be here for some time. I'll endeavour not to be. I'd come at that more from the individual company perspective. What does that mean for the businesses that are in this portfolio and the other portfolios that we run? And you are right. We are seeing. We saw with Tesco's today a really quite a decent set of results, and the DB scheme, the deficit on the DB scheme, blew out by, I forget now, but however many billions it was, but it was very significant. I think it more than doubled the DB deficit. I wouldn't care in this environment to comment about what it means for our industry. I would leave that to there are other people in Aberdeen better positioned to comment on what it actually means for our industry. We have seen over 15 years or so a continual push by pension funds into originally LDI and then other forms of fixed interest and so on and so forth. And perhaps actually they will have to recognise that if they want to earn some kind of return, they need some more equities. I wouldn't suggest that's necessarily particularly supportive of the equity market, but it can't be a bad thing for the equity market rather than can it? If the primary asset class that people have been buying is no longer going to provide them with the return that they want, then they may have to look at other asset classes. And you see across the industry more use of alternatives and illiquids, but you're still talking about 4 or 5% of most allocations in that kind of area, so, and the rest of it heavily weighted to fixed. So there may or may not be, from an industry perspective, an opportunity. But the bearing it would have on Shire's income, crikey, all the way back to the company level, and what the companies have the right balance sheets to be able to support an expansion in their DB deficits.
Ed, thank you very much indeed.
Thank you.